Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shenzhen Expressway Corporation Limited Annual Report. Shenzhen Expressway Corporation Limited offers a diverse range of businesses and services across various sectors. At its core, the company invests in, constructs, operates and manages toll highways and roads, as well as other urban and transportation infrastructure in China. The company provides a wide array of services including recovery and solid waste management, clean energy power generation, construction management, and highways operation management for government and enterprises. It also offers project development, road operation and maintenance, construction consulting, and industrial financial services. In addition to these core services, the company is involved in various other businesses such as entrusted management, advertising, finance leasing, and construction services under franchised arrangements. Property development and management, electronic toll collection and clearing systems, and environment protection and infrastructure construction are also part of its offerings. Furthermore, Shenzhen Expressway Corporation Limited provides a range of specialized services including capital market, wind power, kitchen waste disposal, commercial factoring, environmental and ecological monitoring, agricultural science research, health, elderly care, and nursing. The company is also involved in engineering, business and office, information technology, environment and facility management, real estate development, science and technology promotion, and real estate brokerage services. In terms of specific industries, the company offers leasing and management of apartments, manufacturing of equipment, asphalt materials, and ecological protection and environmental governance services. With its extensive range of businesses and services, Shenzhen Expressway Corporation Limited has established itself as a significant player in China's infrastructure development sector. Shenzhen Expressway Corporation Limited maintains a market capitalization of $26 billion, broadly in line with the industry peer group. Shenzhen Expressway Corporation Limited trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 0.78 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3.35%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a given company can be identified through an analysis of its financial performance across various segments. In this case, the toll road services segment has been a significant contributor to revenue growth, with a 5.53% increase in 2024 compared to the previous year. This trend is expected to continue, with a projected revenue growth of 5.12% in 2025. On the other hand, several segments have experienced significant revenue decline. The environmental protection construction and management leasing service segment has seen a decline of 34.51% in 2024, while interest income has plummeted by 96.15%. These declines are likely due to various factors such as decreased demand, increased competition, or changes in market conditions. The company's lease receipts have also shown a slight decrease, from $1,621,885,091 in 2024 to $1,472,213,365 in 2025. However, the net lease investments remain relatively stable, with a decrease of only $76,544,654 between 2024 and 2025. Overall, the company's revenue growth or decline is driven by its performance across various segments, including toll road services, environmental protection, and finance leasing. Identifying the key drivers of these trends can provide valuable insights for investors and stakeholders to make informed decisions. The net income of the company experienced significant fluctuations between 2023 and 2025. In 2023, the net income was billion, 199,423,679.3, but it decreased by 48% in 2024 to RMB 619,236,894.99. The following year, 2025, saw a drastic decline of 100% with no net profit recorded. However, there were instances where the net income increased, such as in 2025 when it rose from billion, 485,629,540.45 to billion, 126,248,748.56. The reasons for these changes varied across different years and business sectors. In some cases, successful project completions and new business sectors contributed to the increase in net income. On the other hand, impairment losses increased by 73% from 2024 to 2025, leading to a decrease in net income. Profit margins also underwent significant changes during this period. The overall profit margin decreased due to an increase in operating income and total revenue. However, there were instances where specific business sectors experienced an increase or decrease in their profit margins. For example, the Kinglian Company saw its operating income increase, but its net profit decrease, while the Bay Area Development recorded an increase in net profit. The return on net assets was 4.86% in 2025, indicating a relatively stable financial performance despite the fluctuations in net income and profit margins. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash flows from operating activities have increased substantially over the past year, with RMB 4,623,661,085.18 generated in 2025 compared to RMB 3,717,306,471.14 in 2024. This increase confirms that the company is generating positive operating cash flow, a crucial indicator of its financial health and stability. The company's debt level has undergone significant fluctuations over the past year. While short-term borrowing saw a substantial increase of 30.39% on page 28, the total debt level actually decreased from RMB 3,109,300,105.8 in 2024 to RMB 4,282,809,010.26 in 2025, as stated on page 145. However, this decrease was followed by a massive increase of RMB 9,735,932,538.56 in short-term borrowings on page 168. Furthermore, the total debt level jumped from RMB 13,912,273,334.21 to RMB 23,111,419,479.84, as noted on page 184. In contrast, interest expenses have generally decreased over the past year. On page 25, it is reported that interest expenses dropped by 19.67% from last year. Similarly, on page 163, total interest expenses decreased by RMB 210,392,654.93, a 19.7% decrease. Additionally, financial expenses, interest expenses, declined from RMB 1,055,621,345.6 to RMB 774,646,935, as stated on page 169. These decreases suggest that the company has made efforts to reduce its interest expenses and financial burdens. The financial performance of various regions and segments in the company's operations has been mixed. On a positive note, Guangdong Province's Shenzhen region saw significant revenue growth in its coastal and outer ring projects, with year-over-year YOY increases of 10.2% and 8.3%, respectively. Other provinces in China also performed well, with Nanjing Third Bridge experiencing a 7.5% YOY revenue growth. In terms of segments, two-wheeler battery swapping and energy storage products, industrial and commercial battery storage products, and highway construction and operation all performed well, expanding market presence and launching new sales initiatives. However, not all regions were as fortunate. Guangdong Province's Shenzhen region saw declines in toll revenue for several expressways, including Meiyun Expressway, -4.1%, Longda Expressway, -3.2%, and Shuiguan Extension, -4.5%. Other provinces in China also experienced declines, with Changsha Ring Road, -3.8%, and Yicheng Project, -11%, being notable examples. Some segments and regions had mixed performance, including the toll road business, which faced pressures from concession period expirations and competitive traffic diversion. The general environmental protection business also struggled with fluctuations in market-oriented electricity trading and waste collection challenges. On the other hand, the clean energy business did not have any specific performance issues mentioned, but aims to improve market risk forecasting and policy change monitoring. Management is optimistic about the company's future prospects, driven by several key initiatives. The industry will focus on advancing multimodal integration to enhance transport network resilience, and the company aims to moderately expand into upstream and downstream segments using digital technologies. To achieve this, management plans to gradually realize industry upgrading and transformation to improve competitive advantages. This includes focusing on innovative urban construction and integrated infrastructure services in key regions, such as the Guangdong, Hong Kong, Macau, Greater Bay Area, and Shenzhen. In 2026, the company will prioritize lean operations and innovation-led growth to improve quality and efficiency of existing assets. Main businesses are expected to maintain a steady development momentum, with overall profitability and operational efficiency set to improve. The company's strategy also includes advancing major projects in its toll highway business, deepening lifecycle maintenance, and increasing investments in smart expressway construction. Additionally, management aims to boost overall operational efficiency and risk resilience through digital and smart upgrading in toll road business. The company has a history of paying dividends to its shareholders. In recent years, it has consistently distributed a significant portion of its profits as dividends. For instance, in 2025, the company paid out $1,851,731,281.98, while in 2024, it paid out an even larger amount of $2,744,327,547.86. These payments demonstrate the company's commitment to returning value to its shareholders through dividend distributions. That concludes the financial summary for Shenzhen Expressway Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.